Okay, there we are. I want to welcome everybody to our webinar this evening, Buying a Home with Little Money Down. We are pleased this time, for those of you who have attended previously, that this time we have a co-host, and that's Telly Panagakis from our Itasca office of Cross Country Mortgage, who has done a lot of research and put a lot of effort into this presentation. And I'm going to turn it over to Telly so that we can take it over that way. Real quickly going through some of the basic stuff, information about myself, a little brief one on Telly, and from there, Telly, you should be able to take over.
Yeah, so what we're going to do tonight is talk about how to structure a purchase so that you can do it with very little to almost no money down in some cases, based on a couple different factors. So if we'll go to the next slide, and I'll get started on that. So the things we're going to talk about today is the programs that best suit the situation. So everybody knows FHA has always been around, 3.5% down, allows for, some of the lower credit scores, stuff of that nature. But so Fannie Mae and Freddie Mac have also opened up a 3% down program for Fannie and a 5% down program for Freddie Mac. And then obviously we have the IDA program, which is the Illinois Department of Housing Authority, and they give a grant as well. Now, we're not going to focus too much on that tonight. I'm going to show you how these other programs will actually benefit your clients more so than the assistance program even. And, it's nothing against IDA. IDA is a great program for those that have very little resource. But for those who have resources but just don't want to use the money, so they have the 401k, they have the savings, they have all these items, but they don't want to necessarily deplete that stuff, this is going to be the alternative to IDA and give them the biggest benefit for their buck. So if we'll go to the next slide, we're going to talk about Fannie Mae and Fannie Mae Home Ready and Freddie Mac Home Possible. So the benefits are this: 3% down, and this money can be a gift. It could be your 401k. It could be any type of sourceable funds. Okay. It allows, and this is the biggest, I think, the biggest benefit of all. So most people that have very little money to work with, and I shouldn't say most, but a lot of people want to buy condos. And when you want to buy a condo, if that condo is not FHA approved, then you can't buy that condo with an FHA mortgage. So if you sit down and really think about how many condos there are out there, I would say not even 10%, at least from my own experience when we shop condos, not even 10% of condos are FHA approved. So that person who's looking for a condo that wants to do it with 3% down, or for very little money down, now they're excluding a huge part of that market. These programs do have lower interest rates than conventional mortgages, and they also have a lower mortgage insurance premium than conventional mortgages. It's not for first-time home buyers. So if you own a home, and let's say you own a home and you want to upgrade, you can keep the old home as an investment property and buy a new home with this particular program. And it allows for credit scores down to 620. So it's very aggressive in its, in how it deals with credit. So if we'll go to the next slide. Now we know IDA offers up to $10,000 down payment assistance. It's forgivable after 10 years. I think it has, and this is an older slide, so I think the credit score might be 640 for FHA as well. But because you're using the down payment assistance program, you're only allowed to use one lender, or we're only allowed to use one lender, and that interest rate tends to be a little bit higher. So, the old saying, I hate to say it this way, but the old saying, nothing's free, this is true even in this case. So the other part is, let's say 2 years from now, 3 years from now, 4 years from now, you want to refinance because rates got better, you want to do some cash out or do some other things, you have to pay that grant back if it's not with, after those 10 years of the forgiven part. Now, again, I don't know the specifics on it. It's been a while since I've read up on it because honestly, we used to do a lot of them a few years ago. And ever since we built this program, we've had very little reason to even lean on IDA. On an occasion, when somebody has, no resources, absolutely, we're going to make sure that client gets, the benefit of IDA, get them into the house, help them in any way we can. But at our branch, we haven't really needed it because most people have, 401k or have gift funds that they can, receive, and so on. So if we'll go to the next slide. So this is how we're going to structure this deal, okay? And there's three parts of it that's very, very important. You're going to have seller concessions. And so in layman terms, let's say you're buying a property for $250,000 and you want to negotiate the price down to $240,000. Well, instead of negotiating the price down to $240,000, what you can do is say, listen, we will give you the $250,000, but we want $10,000 of that to go towards seller concessions. Now, these concessions can be used for processing, underwriting, title charges. It can be used for setting up escrows. It can be used for transfer stamps. I mean, it can be used for pretty much everything. Now, what's really cool about that is you can also use the money left over. Let's say we only needed $7,500 and there's $2,500 left over. Well, the difference between $250,000 and $240,000, the purchase price, and again, this is very general, but it's about $50 to $55 a month more. Well, if you had $2,500 left over and you take that money and you buy down the interest rate with discount points, you actually would have a better savings with the discount points, even though that your loan amount was a little bit higher. That additional money would drive down that payment by getting you a better interest rate. The second thing is prorated taxes. Now, the state of Illinois, when we pay taxes in 2019, we're actually paying for the taxes of 18. So when you go to buy a house in July, that person is going to owe you all of last year and a portion of this year. Now, if they paid the March installments, let's say in Cook County, they wouldn't owe you the first installment. They just owe you the second half and then the first half of this year. So you can get almost, in this case, let's say now in July, we paid them in March, you get almost a year's worth of taxes. So, taxes being extremely high in Illinois, as far as how I feel, those credits are pretty large. Now, when you go to sell the house, you're going to be on the other side of this equation. So you're going to be giving that person the prorated taxes. So you're going to be paying a chunk of the money that you were going to get at closing towards those taxes. And the last thing is lender credits. And this is when you can choose a different interest rate. Just like we talk about buying down the rate with a discount point, this is talking about buying up the interest rate so that the lender gives you a credit towards your closing costs. So let's go ahead and look at some examples. All right, so this is how rates work. Now, these rates are a little old, they're expired, but it's going to give you a general understanding of how rates work. Now, if you look at the 4.625 and you go across, it would cost you 2.572 points. This is when you're using the extra money you have left over to get the better interest rate, okay? The 5 1/4 in this case is what we consider the par rate. It's the last rate before it starts costing money. In this case, you're getting a $338 credit towards the closing cost. Now, this is for a mortgage. I think it was $110,000 when we did it. But if you look at the 5.75, the lender will actually give you $3,300 for you accepting that interest rate of 5.75. Now, if you look at the difference in the payment, you have the equivalent, $36 a month. So if I was to give you $36 a month, or if you were to pay the lender $36 more a month, at closing, you're going to receive a $3,300 credit, which is going to drive down the amount of money that you need to bring to closing, okay? If we'll go to the next slide. All right, so I don't know if you guys can see this very well, but we're going to go over kind of a fee breakdown of a mortgage, okay? So the first thing you'll see is processing and underwriting, okay? These are very standard type charges. Some lenders are a little bit, inexpensive on one or more on the other, but for the most part, this gives you a general idea. You're going to have a processing fee, you're going to have an underwriting. The next part is the appraisal, the credit report, and the flood cert, okay? All obviously necessary things to get a mortgage. After that, you're going to have your title charges. Now, the lender doesn't choose the title. The seller attorney usually chooses it, but the buyer does have the right, if they want to shop around and get their own title, okay? So when you add up those items, you're at about $5,000 in closing costs. Now you're gonna go to the recording fee. And after that, you're setting up your homeowner's insurance. You have to pay out for 12 months. And you're going to have per day interest. This is how you pay the interest of the first of the month, and then your next payment is the following month. Excuse me. After that, you have your homeowner's insurance, escrow setup, and your property taxes. Now, based on the time of the year that you close, that amount's going to change. You'll have the attorney fee, and if you look at the bottom, this came out to $7,182. Now, in this particular instance, you have a lender credit. The person chose a credit that gave them, or they chose a rate that gave them a $5,200 lender credit. So that drove all that cost down to about $2,000, okay? Now we'll go to the next slide. On the left-hand side is going to be what's going on for the borrower. On the right-hand side is what's going on with the seller. We're not going to focus on the right side. We're going to focus on the left side. The sales price was $114,500. You had $1,900 left over in closing costs, because remember, the lender credit was $5,265, give or take. So you need that top number. You need $116,550 to make this deal work, okay? Now, the lender, or if you look at the bottom, this person had already paid $1,000 for their earnest money. The loan amount is what the lender is giving, which is $111,065. Now that is reduced by 3%, which is your down payment. The seller gave you a credit of $3,000. Below that is the prorated taxes. In this case, they're giving you taxes for from January until March, and then they're also giving you January to March for the assessment. But nevertheless, you're getting about $1,900 in prorated taxes. So in this case, and this is absolutely one of my favorite deals I've ever done, in this case, the borrower actually received $500 of the $1,000 deposit that they put up top. So the total out of pocket that this client had to deal with, aside from inspection, because that, we don't require that, the total out of pocket was $500. So for a $100,000 condo, I think this is an absolutely greatest way to structure it, because remember, for every $10,000, it's only saving the client $50 or $60. So I don't want my client to go into a property where they've given up $10,000 worth of money just so that they can save $50 a month. That doesn't make sense to me, because what happens down the line if you have a furnace that breaks, you have some issues that come up, you should always have a few months of reserves, because in an economy, jobs get lost, jobs get rehired, you just never know. So it's good to have that little bit of savings on the side. And I think it's better than just throwing it into, putting it all into the mortgage. If we'll go to the next slide real quick. All right, so this part I'll go over real quick. Obviously, you have all of Jim's info, but this is kind of, so what Cross Country does, we have what's called a fast track credit approval. It's fairly simple. Step one, you apply for a mortgage, and step two, you get the buyer's letter. What we do, which is very different than most lenders, is while you're looking for a house, step three, we're actually taking your file and we're underwriting it. We're clearing all the conditions. So when you do find a home on step four, all we need to do is the final things, which is property specific. You got to get the appraisal, evidence of insurance, and then, and in this case, from the time you get the contract to the closing, we've had files close as fast as 10 days. Now, why is that important in this market is if you're competing against, 4 or 5 different lenders or pre-approvals or buyers for that matter, and you say, listen, we'll close in 10 days, and here's my certificate showing that we are 100% through underwriting minus the property, even if your offer is the same or a little bit less or a little bit more, that certificate and that confidence that you're going to close in 10 days will almost always win, that contract, because these people that are selling houses, they want confidence that their house is going to close and they're going to move forward with the next steps in their life. So that's a little bit about the fast track credit approval. James, we'll go to the next slide. We'll skip this one. You got James' information, so anything you need, just go through him. Ask screenshot if you never know.
Take a screenshot of that one too.
Let's go to the next one real quick. This is the legal disclaimer. Are we not doing the credit score part?
It actually wasn't included in what was sent to me.
Okay, we'll save it for another time then. That's not a big deal.
Yeah.
So yeah, we'll do that as a follow-up. I think it's very important. I think it's got a lot of good information, but I think this way we can keep them pretty short. So when people go online, they're not taking a half hour out of the day just for one video. We'll just break it down and do it that way.
Right. Okay. We do have a couple of questions actually. Here we go. Jack from Dixon wanted to know how does this work with a VA loan?
VA is even better. So with a VA loan, you're already given the 100% financing, and VA so you have PMI whenever you don't put 20% down on a conventional mortgage or FHA mortgage. FHA you always have it. That's a whole nother. With a VA, they charge no monthly MI, but where a lot of people that have VAs get confused is they said, well, the VA says that they'll do 100% financing. Why do I still need to bring money into closing? Well, the VA will give you 100% financing of the purchase price. So if you bought a house for $200,000, the VA will give you the $200,000, but that doesn't include all the other charges, title, appraisal, all those things. So if you go to a place and you say, hey, listen, I want to buy this place for, 190 and they have it listed for 200, say, listen, I'll buy it for 200, but I want you to give me 6,000 or 7,000, and again, you're going to talk to your loan consultant and say, hey, how much do I really need? We don't want to ask for more than what you need, because if we don't use it, it goes back to the seller. I mean, we could use it to buy down the rate, but again, you want it to be somewhat reasonable in what you're asking, for what the market holds. Now, VA will allow up to 4%. So on a $200,000 purchase, you can ask for up to $8,000 in credits. Now, if you're in an area where the taxes might be lower, you might want more of a credit because you're not going to get a lot of prorated taxes. On the flip side of that, if you have a property that has a very large tax bill, now you may not need as much seller credit because you're getting a larger prorated taxes. But in the VA loan, you got to remember, they're only financing the purchase price. They're not financing closing costs, prepaids, escrows, all this other stuff. So yes, it's super important if you really want zero money out of pocket for a VA, that you ask for the right amount of closing costs, credit, seller concessions, and so on.
Okay, and then Anna from Rockford is asking, what if the seller won't give a credit?
Well, you're always going to be up against that occasionally. It's very rare. I shouldn't say, yeah, I will say that actually. Out of the deals that I do, 90% of them have seller concessions. So if you have a seller that says, what's my bottom line? Like, what's your bottom line price? He says it's 145. He had it listed for 151, 152. Say, listen, I'm going to get you the 145. I just want us to write the contract for the 151, and I want the difference in seller concessions. Now, I can't guarantee he's going to say yes. You're going to have times when people are being unreasonable, because to me, that's really what it is. If you're still getting what you want out of the deal, and you're not willing to write the contract so that it's structured properly for the person buying the property, you might have yourself just the wrong property or the wrong seller, because what happens when you get through inspection and you say, hey, I got a couple problems, and they're not willing to work with you at all. So I always say, just because it's, don't put too much emotion into the property if you got the wrong seller. So you throw it out there, you see what they say. If it works for them, it does. If it doesn't, you know what I mean? At that point, you got to make a decision on how much money do you want to come out of pocket for this house. You might say, hey, this house is so worth it that I don't need concessions. I'm willing to pay the closing costs out of my own pocket, and that's fine too. But that's more of a individual question once you get to that point, is how much money are they working with? Is this the right property? And am I willing to give up that amount of money without the concessions to get it done.
Okay, and actually, a follow-up really to the same question of Debbie from Springfield is, do all realtors know how to negotiate for a seller credit?
I can tell you this. So the realtors that I work with, when I first, created this, they were very hesitant because they felt like it was a big takeaway from the seller and that we were asking for too much, or they didn't think the borrower was strong enough because he needed this extra help. So through a little bit of coaching, I explained to my realtors, I said, listen, these are Fannie, Freddie, FHA guidelines. We're following their guidelines the way that they wrote them. So we're not asking for anything crazy out of this world. We're asking for what, these institutions lend and how they lend. I go, sometimes you just gotta have to go into it with an understanding of maybe you don't want to bring that up right away. Maybe you just want to find out what their bottom line is first and then add to that bottom line to get to that number. But again, you got to remember, a lot of realtors, they're not mortgage loan officers. And some of them try to do their very best, but a lot of the information they get is very secondhand. I mean, I've literally have realtors, new realtors I talk to all the time going, 3%, that's insane. You can't do that. Or, this house, FHA won't pass this house inspection. I go, why? And they'll give me some weird reason. Like, that is nothing, FHA could care less about that. So I think part of it is just educating our client or our realtors of why this or how this program works, why it works, and how it ultimately benefits their client. Because if you have a raving fan that's their client, they're gonna, we're a direct reflection of that, of that realtor. If we do a great job and we wow them, then they're going to remember that realtor every single time and say, I remember, the lender was able to. And you're going to get new realtors and you're going to have to kind of work with them, coach them through the situation. But most realtors, once they understand and they understand it's guidelines and there's nothing wrong with it, most of them have no problem going out there and doing it.
Okay. All right, well, that's all the questions we've received so far. I want to again thank Telly Panagakis from our office in Itasca. I'll give you guys a quick, there's his information. Certainly feel free to give him a call. He does know what he's talking about when it comes to this. He's done it a lot. Going on, we're going to take a little bit of a break due to the holiday coming up, the 4th of July. But as Telly mentioned, IDA's really a conversation by itself. The program is good for the right person. It is not the answer for everybody. I actually think there's more people that could be benefited by Telly's concept than on IDA. But as an example, my friends up in Rockford, IDA is an outstanding program with the down payment assistance. So we're going to be having a Understanding IDA webinar coming up on July 11th. So we're going to be about 30 days out instead of the normal 2 weeks. And then with that, of course, certainly feel free to give me a call or drop me an email or visit us on Facebook. Telly's on Facebook also, so certainly feel free to reach out to him. And I appreciate the fact that you guys spent a little time with us this evening. With that, thank you.
Awesome. Thanks, James.